Hi, students. Um, I think I just promised you to give a presentation on share-based payment covering the leftover portions. So in this session, let me just go through the example we tried to work out in the class, plus the additional details of share-based payments, including the implications of ESOPs. Then once I'm done with that, I'll shift to one share appreciation rates-based calculations. What I would like to do just to help you focus on the calculations of the screen. I'll just disable my video. I think that would be better. Yeah, so here we go. Coming to share-based payments, all the types of share-based payments, just not ESOP. ESOP is one, of course, one of the big issues involved in this particular gap. The gap number that we talk about is IFRS 2, and the corresponding counterpart is Ind AS 102. That is applicable to the listed companies in India. So the issue we are trying to cover is that what to do in case of equity settled share-based payment transaction. If you recall our classroom discussion, I just try to explain this extended expression in the gap. Basically, the transaction value rather is based upon the share value, and ultimately you are settling the transaction by issuing equity shares. And in ESOP, exactly that's happening, right? So when do you think about these transactions? Quite possible that, forget about ESOPs, quite possible a company might get even inventory from somebody, but instead of paying through cash, the entity can decide to issue securities provided the supplier is willing to be a kind of partner. By buying a share, I do believe you become a partner in the purchase of the enterprise, isn't it? So an enterprise can receive goods or service as consideration for its equity instruments. And when it comes to ESOPs, stock options given to employees are working for the company. So that's the service they're rendering, and companies getting that service as consideration for granting the stock option. So these are the transactions where you think about this equity settled share-based payment. Coming to the accounting issues involved, whenever a share-based payment is happening for goods or service, please understand that the goods or service you are getting could be an asset. Example, I'm getting a machine, so it's an asset, and then I'm getting service from employees, it's an expense. General principle involved in such cases that the value of the asset or the goods or service, whatever you are getting, should be the fair value of the goods or service received. At the outset, you don't think about the equity instrument's fair value. Gap is very clear to say recognize at fair value of the goods or service received. So what we'll do right now, we'll just run after this particular sentence and try to invoke a small example next slide to see what is the thought process in the gap when they say the transaction must be recorded at fair value of the goods or service the company has received. So let us take a small example. You are buying a plant whose cash price is rupees 200 million. Means if you just go to the market and buy it today, you have to pay this price of 200 million rupees. Then you contracted with the supplier and you said that I am going to settle this transaction through issue of 1 million equity shares of my company, whose face value is 100. So 200 million rupees, let us say the machine you are getting, you are just going to issue 1 million equity shares. So how to put it in the financial statement of X Limited? It's a very, very simple example we're trying to talk about. So you know that any value over and above the face value of the share has to be recorded as securities premium. So the transaction recording takes this shape. I think we'll just put it here. Uh, if this is the transaction, then obviously you will say machine value has to be the fair value of the machine. That's what the gap is trying to say. If you go back to the previous slide, you say take the fair value of the goods or service received. So it is 200 million. It's not 100 million, right? But you have issued only 1 million. I'm just sorry. You have just issued 1 million shares. You have not issued uh, 2 million shares. Therefore, the equity share capital, you know that equity share capital of a corporate has to be stated in terms of face value only. That's what corporate regulation is directing us to do. So equity share capital will go up by 100 million. I'm not putting it in the typical debit credit column. I hope you will be able to understand that. Here I can just write this you have to debit, right? Asset is increasing means machine you are debiting. And equity share capital is in the other side of the accounting equation that is also going up, so you have to credit. And balance must go to sorry, balance must go to securities premium, and that should be 100 million, 100 million because you issued 1 million shares, and that increases the securities premium by 100 million because the transaction value is at 200 million. So the difference you just put in the securities premium. That's it. We recorded the transaction. So if you go back, then we just said that we have to recognize the goods or service received. Here we have received the machine, okay, at fair value of the machine. We did not take the market value of the share of the company, assuming it's a listed security. GAAP says that the fair value of a listed security will be the market value. We did not consider the market value of the share at all. So to start with, this is the principle. Then the GAAP proceeds to say, however, if the fair value of the goods or service received by the company cannot be reliably measured, then take the fair value of the equity instrument granted. So then in this context, I believe your ESOP accounting comes in. What is happening in an ESOP? Employees rendering service. But one part of the remuneration you are paying in cash, right? And then another part you are paying in terms of share that eventually the employee will get upon exercise of the option, isn't it? So the problem here is how to ascertain for what percentage of service the employee is rendering to the company we are giving share, and for what percentage of service we are awarding the employee with cash compensation. And since you cannot have a reliable measurement, if you just think about it, it's not possible. So you will bring in use arbitrary judgment to say, okay, for 60% or 70% of the job or the service the employee is rendering, I have given cash compensation. And I believe with each person this judgment will change. That is when exactly the fair value of the service for which the option is granted cannot be taken. Rather, you have to take the fair value of the equity instrument. The stock option is the equity instrument, right? So we are taking the fair value of the equity instrument rather than fair value of the service the employee is rendering. So I think these are the two issues involved, the general principles involved in this particular gap. So once you understand that, I believe we can proceed. Then coming to specific discussion on stock options granted. Okay. So when you are granting equity instruments, it is quite possible, please don't fall into the trap of thinking that whenever an employer, a director, or anybody is rendering service, eventually the company only gives, stock options and later on these people opt for the share. No, not that way. Quite possible. In recognition of past service of a company, I'm issuing some shares today. So here there is no vesting condition attached because it is vesting immediately. Because you are going to recognize the past service, quite possible. Some of the employees give a exemplary contribution to the company. They're very devoted people. They work for long hours, not just long hours, they give quality output. It's a discretion of the top management to take a call on it. So that could be the possibility. What we'll do right now, we'll just take a small example. If you are just giving some equity instrument, let us say you're giving shares straight away because of the past service of an employee. So we are just trying to say it is vesting immediately and the recognition has to be immediate. It is not that there is a vesting period of 3 years or 4 years. If you recall the example in the classroom, we are not going to spread the expense over 3 to 4 years. You have to recognize the expense immediately because you are just giving it in recognition of the past service of the employees, right? I hope there is an example. Just see or no. I think in this slide deck, I've just deleted that example. So we can just, as usual, we can just put here one example in the notes. Suppose you are giving 100 shares to one employee, and today the fair value of the share, that is the ruling market price, is say rupees 1000, just a small example. Then because this employee has worked with you for last 2 years, so today you are granting these shares to this person or issuing these shares to this person. So the value is 1000 into 100, and this should be immediately charged to the P&L this year because there is no scope for you to reopen the concluded accounts of the last 2 years and then revise incorporating or spreading this expense over the last 2 years. There is no such possibility as far as corporate accounting is concerned for such items. Then the only way out is that you have to charge to the P&L immediately. I think that takes care of this left-hand column, what we are trying to say. But when it comes to vesting conditions, as you know, vesting condition can be of varieties. One of the simple vesting conditions is a service tenure. You work with me for 2 to 3 years or 4 years. That's the kind of thing. And you can couple that kind of vesting condition with some performance condition. Means you are going to give a target also apart from just completing a tenure with you. Sorry. Then those performance conditions will be divided into non-market condition. Example, if my revenue crosses, let us say 30,000 crore in any year, then I think you will be eligible to exercise the option. That could be a condition. So it's a revenue target you have given. Or you can give a profit target also, my net profit or EBIT, whatever. You have to define it in the contract. Or you can indirectly say that my ROE should be minimum 20% on an average for 3 years. Then anytime you can exercise the option. That's the kind of option you can give. It's called non-market condition because these kind of conditions, revenue, profit, or ROE, these targets are not linked up with the share price of the company in the market. But you call a condition as market condition if at all the linkage is with the share price or the option value itself. Okay? So that's the market condition. As you know, or as you will know, I think in your derivatives course, one of the input values you calculate is the share price, isn't it? So option will derive the value from the underlying, isn't it? It's a derivative contract. So and then we'll take, I think this is the example we just worked out in the class. As students, I think there is some background noise, okay? These people around the they are shouting a lot. I don't know whether that voice is reaching or not. Okay. Please take care, okay? Coming to this example, we just granted let us 100 stock options to each of our 2000 employees. And the condition is that they should complete service of 4 years. It's a repetition since I think without this discussion, the flow will not be maintained. So I'm just covering it for revision purpose for you. And the grant date we defined is past April 2020. And your accounting year is ending on 31st March every year. And on the grant date, fair value of each option is rupees 40. So to make it more explicit, I can just put it on grant date. Okay. And based upon your past experience of employee turnover, you just predicted that the cumulative number of people who leave within 4 years will be 600. That is 30% on the base figure of 2000 employees. So you are expecting that 1400 employees will fulfill the vesting condition and eventually exercise the option. And then you experience that in 2021, actual employees who left you is 150. But your estimation of 30% remains unchanged. If that remains unchanged, then I think you are not going to revise the calculation of options value based upon 1400 employees. Okay, let us go and check what happened in the past year 2021. So the total option value will be 70% of 2000. That is, this part is 1400 employees, isn't it? And we are taking as usual the granted fair value of the option. Some of you should take note. I think some are clear and some are not that clear, I think so. So for the kids who are not very clear on this thing, we are not taking the fair value of the share, but we are taking the fair value of the option. Let us keep that in mind very clearly. Because in a question, suppose that information has been given, the fair value of the share on granted is, let us say, just a number rupees 200. That is just to confuse you. You have got nothing to do with that value. So run after the fair value of the stock option, that is 40. So the total option charge is 56 lakhs. Yeah, each employee was given 100 options, right? So 100 into 1400 into 40. Therefore, since the vesting period is 4 years of service, we just spread it over 4 years, 14 lakhs. Okay. If your expectation about this employee turnover remains unchanged, 30%, and then let us assume at the end of fourth year, you find that exactly 600 people have left. Then all that you are going to do is that repeat this transaction 3 more times. I'll again repeat what I said. If for all the years at year end on 31st March, when you sit down to do this journal entry in your books of accounts, you find that again your expected number of people who leave is 30%. Okay. Then in the fourth year, you will have the actual situation. The fourth year, you exactly found that 600 people have left. So obviously, 1400 people have invested with the option, isn't it? Therefore, just repeat this 14 lakh kind of entry every year. Every year, your P&L will be charged with employee compensation of 14 lakhs. And in the balance sheet, obviously, you'll have accumulated share options figure sitting under equity, one of the components of equity as per GAAP. That will be 56 lakhs. Then we'll issue the shares if they exercise the option by paying the exercise price. We'll talk about that after a while. But what if the expectation changes? This is the slide you'll find if everything is going as usual. Okay, 600 people have left. Ultimately, 1400 people gave you the cash upon exercise. You can see 1400 exercise price in the question is given as 100. 1400 people, and each employee was given 100 options, so 2 more zeros, and then for each option, the person will give you 100 rupees, right? So further 100 rupees. So this is the total cash the company received. And you have to debit now because company is receiving cash. Cash is an asset which is increasing. So 1 crore 40 lakhs is the increase in cash. Now the share option sitting under equity so far over the last 4 years has to be reversed now. Because the total value received by the company in terms of their labor is 56 lakhs. Because over 4 years you said your employee benefit expense is 14 lakhs. So the total value of service you have received is 56 lakhs. Plus the cash now they pay you is 1 crore 40 lakhs. So all these two figures were debiting. And equity share capital must be stated in terms of face value. So it is just 14 lakhs because 100 rupees is the, let us just check, 100 or 10 rupees is the face value of the share. It must be given. Yeah, face value of each share is rupees 10. Okay. Then we just go back. Yeah, we're here. So the credit is equity share capital 14 lakhs. And the net difference between these two figures 1 crore 40 plus 56. That difference goes to securities premium. But it's very unlikely that over the next 4 years, the expected number of 30% would remain unchanged at every year end. Then exactly 600 people would leave you as per your expectation. It's very unlikely situation. So we just bring in some kind of change into that estimation. So what if next year in 2021-22, 50 more employees leave and you are revising the estimation to 80% vesting. Previously, the estimated vesting was 70%, right? And let us, as per this new revision, work out the total option charge. Option, but if you are saying that it is 80%, then the value of total options will change because it's no more 1400 people. I believe it is 1600 people, isn't it? So 1600 people, and each person has been given 100 options. So 1600 into 100 plus the fair value of the option on grant date is 40. We are not going to take the fair value of the option on 31st March 2022, but the grant date was in the previous year. That date we are just adhering to. That's what is told in the gap. We can't help it. I think in the class somebody had asked me why is that the gap is not taking the revised fair value. It's possible that the share price might go up a lot, might come down a lot, depending upon that the options value will swing. One of the issues in accounting is that there is a possibility that the option value will drop significantly. I'm just assuming the price of the share will drop significantly. And for example, let us look at one share, TTK Prestige share. Within just last 1 year, it has increased by 31%. Of course, compared to the lowest level it had hit, it is 31% in. So, if gap is permitting recalculation of the options value, taking the latest options price, quite possibly you will even instead of hitting the P&L as a charge in particular year. Let us imagine within the last 2 years you have already charged to the P&L cumulatively 40 lakhs as per our original calculation. But now you find that within 3 years the total charge to the P&L should be 30 lakhs. Then it essentially means your P&L has to be now credited with 10 lakhs of income to bring that correction, which is a highly undesirable consequence of this accounting because you are giving some shares in recognition of the service. So the value of the service today is negative. That's a bit inconsistent with our common sense even, isn't it? Therefore, we, as an equity analyst, we criticize a lot of issues of gap, but please understand that gap has also its own compulsion. It's meant for market reporting. And one of the large issues accounting tries to address, despite all criticism, is that my data must be objective. I can't make it very subjective, number one, or I cannot have a number like here, negative figure, means negative value of employee service I'm getting is a conceptual and inconsistent outcome, undesirable outcome of that kind of calculation. So I think this explanation would satisfy whoever had asked that question in the class. Why is that we are sticking to the granted accounting always in gap? Okay, let us appreciate the limitation of gap. Yeah. So coming to yeah, if it is 64 lakhs, I think for the next 2 years, we'll just repeat it. Why 2 years? Because if you read this question, actual vesting in the last year is 75%, means it will go for one more round of recalculation. That's the issue. And this 80% expected turnover, you are going to maintain over 21, 22, and 22, 23. Therefore, we are not touching it for the next 2 years. Just repeat this transaction of 16 lakh 66,667 done. If you go to the last year, then 75% out of 2,000 are actually vested. So the number of employees is 1,500. So 1,500 into 100 into 40, total options value is 60 lakhs. And already in the last 3 years, we have charged our P&L to this extent of 47 lakh 33,330. What is the number? So the balance to be charged to the P&L in the last year is the remainder figure, 12,66,666. So as on that, the share option that would be outstanding would be 60 lakhs under equity. So as usual, I think they will give you cash. Cash has to be debited. Stock option has to be debited because it's a reversal only that you are doing. Then in terms of face value of the share, you have to increase the your equity share capital. Then the balance figure will go to securities premium. We are not discussing or repeating that kind of thing. Now we'll address one small issue involved in this stock options. What if employee to whom you have given stock option has left? Here, please don't confuse why this kind of reversal entry we did not talk about in the previous example. Please understand that conceptually there, you have not actually accounted for the employee who is leaving. Therefore, we did not talk about any reversal there, right? So keep that in mind. Otherwise, this kind of example can create some confusion. Let us assume we have given vesting period of 3 years and just to one employee, just to conceptualize. So the significance of telling that is for one employee, because I have already accounted for, then the employee is leaving, then this example fits in, otherwise it would not be the case. So out of 3 years, let us say 2 years are over, and each year obviously you would have charged 3 lakhs to the P&L, employee benefit stock of some 6 lakh. So earlier 2 years P&L has been charged with 6 lakh of expense cumulatively. Now in the third year, this employee is leaving, means obviously this employee will never be vested with the exercise power. So then accounting or GAAP is saying that you reverse the 6 lakh charge of earlier 2 years. So by crediting third years of income statement, it means why is that GAAP is allowing this now? Please understand that you ultimately wanted to pass on a share to the employee, and obviously that's a value sacrifice. So for 2 years, two-thirds of that value sacrifice eventually you have calculated and hit your P&L and brought down your profit. But now you understand that that value will never move because this person is leaving, and I have already accounted for the charge. But this value will never move to this employee. Therefore, I just need a correction in my cumulative profit figure. So hence, I'm just reversing this entry. So how do you reverse the stock options of 6 lakh sitting in the equity figure in the balance sheet? You are taking that to the income side of the P&L, right? So 6 lakh, that's how you're reversing it, and ultimately that enters into retained profit. I hope you understood the complete path of this 6 lakh figure. It was in the balance sheet. It comes back to the P&L income side. Therefore, it enters into retained profit, and then retained profit also goes to equity. So the sum total is that via media the P&L, this 6 lakh transferred from stock options to retained profit. Okay, of course, subject to the tax figure, because anything that goes to the P&L will be hit by the tax figure, isn't it? Then what if there is a cancellation of the option scheme? Before you understand the harsh consequence contemplated in accounting, if an entity cancels any scheme subsequently, you need to understand the rationale. Imagine that I'm a small company, not in the sense I'm not talking about kind of companies like TCS and other things, because subsequent cancellation of ESOP scheme in these large listed companies becomes more or less impossible because of various dynamics, employee dynamics, market dynamics, etc. But what if I am a small company? All promoter driven agenda runs there. I talk to my employees, then I say that, okay, I'll give you stock options because I have learned from accounting that if I give you stock options, my expenses would go up, then I'll be able to report less profit. That is my objective for some reason. But so I do that. Then let us assume that on granted the fair value of the options I've given to my employees is $6 lakh US dollar, and vesting period is 3 years. So expense recognized in 2022-23, that is the first year, is 2 lakh rupees, one third of 6 lakhs. Okay. Oh no, sorry, not rupees, US dollar. Then in the next year, I talk to the employees in collusion with my employees. I just cancel the scheme completely. Why did I cancel the scheme? What is my motivation to cancel the scheme? Let us assume that year I found that my business result has gone down. So I know that this option scheme which is pending, that will also create an additional charge to my P&L. Therefore, my profit will become adverse. That's what I don't want that to happen. So I talk to my employees, and since they are all people working in a promoter-driven entity, not professionally managed, okay, obviously for fear of losing job, they might agree with me. So then I cancel the option scheme. So to dissuade a company not to, I'm saying, you should not do this, right? But this was the practice in some cases. Obviously, the accounting regulator, they observed these abuses in the market. Then they said, if you cancel, your objective was to help your profit look bit healthy. But what we will recommend is that the remainder part of the total options charge will be hit in that year itself. Means it's an accelerated charge that Gap is talking about. So the acceleration means the accounting motivation for cancelling the ESOP scheme is no more there. That is how you understand. I think this is also an example uh, to explain, sometimes, gap might look unreasonable to you, but gap has also some purpose to achieve. Okay? Unless you know the background, you will not appreciate why the gap is trying to do like this. So that is called, in a nutshell, you can say cancellation is leading to acceleration. So if somebody asks you why this acceleration, you say that to dissuade the entity or the employer from cancelling the ESOP scheme subsequently, with an objective to keep the profit figure healthy. So this is how accounting is demotivating the entity. Okay, and I think then quite possible. Sorry, the scheme, the exercise price you may change later on. Why should you change the exercise price? Imagine that the share price of a company for business performance for some reason has come down. So now you see that the option is out of money, and it is a matter of time only the employees will exercise the option. But you find that quite likely nobody would opt for that because the option is out of money by that time. That's what you expect. Then to make the option look more attractive, or for that matter, to make it again move to the money zone, means profit zone. That is when you say in the money, isn't it? Out of money, in the money. So you revise the exercise price. Suppose initially you had said 100 rupees is the exercise price. Then today you are saying I have revised it to 60 rupees. So question is, what is the impact of this modification as far as ESOP accounting is concerned? Okay. So we don't have an example because I think it will be just repetition. If you just keep this in mind, the second bullet point, I think it will make sense because you already know the manner of calculation. We're just trying to say, you can just read it, and it goes like this. If you modify, then the effect of that modification you have to capture only prospectively. No way you can go back. And with retrospective effect, you can modify the concluded year's P&L in the year of modification. That scope does not exist simply. So the only way you can accommodate the effect of this modification is prospectively. So what you can do, you count the expense based upon original contract, that is before modification. Suppose without this modification in this year, I would have charged to the P&L, say 10 lakh rupees. Now I have modified the scheme. So once I modify the scheme, then I need to think like this. The modified scheme is a new scheme that will be valid from date of modification till vesting date. So if I imagine that a new option is a scheme, then I can also quantify the expense of that new component. Okay? Then expense based upon the original contract plus expense on modified contract. Both together I have to charge to the P&L. But there is a possibility. Upon modification, the fair value reduces. If the fair value reduces, then GAAP is saying that ignore that because any reduction will not be accommodated, but any increase will be accommodated. So that's why we are trying to say modification can only increase expense, not decrease it. That is how I think accounting has some conservative rules. As you know, this body knowledge is a bit conservative, isn't it? So that's, I think that explains some of the issues involved in ESOP. That is, we learned what is modification. We learned what happens in case the ESOP scheme gets cancelled altogether. I think we also understood immediate vesting. That is when we are immediately charging the P&L, right? So with this, we'll just go to another example on ESOPs where we have a kind of performance target apart from service condition. I think this example we just now went through is just a simple vesting condition of 4 years of service, isn't it? So from here, I'll just take you to an Excel file. Both these things will be, of course, recorded on the screen. Therefore, I don't think you need my files separately. Okay, just zoom it a little bit. Yeah, here we go. So this is an example where we are trying to bring in non-market condition. That is my ROE. I'm talking about a target ROE. Okay, let us see the question. Suppose on 1st January 2015, X Limited granted 2000 options to a particular director. And vesting condition you gave is 3 years of service. That is service-based vesting condition. And you said exercise price is rupees 40. Then you said if ROE increases by 10% on an average over 3 years, exercise price will be rupees 30. Means what? The director will pay less money, 10 rupees less. Therefore, the upside potential for the director would be higher. That is how you define the scheme. So you can see in the scheme there are two conditions. One is completion of 3 years of service, plus the return on equity of the company. You have set a target. Over 3 years, on an average, it should be 10%, not less than that. Okay. So we just, as usual, require some input data to go ahead with the accounting discussion. Fair value of the option on grant date based upon exercise price of 40 is, let us say, rupees 15. And had you set it at rupees 30, then the fair value of the option would have been 18. Before we proceed further, you just need to understand one thing here. This rupees 15 and rupees 18, please understand that both these values are on grant date. Please don't think that if at all the company will revise the exercise price to 30 tomorrow, then this 18 rupees value is the value of tomorrow. No way. Because you can't abandon grant date accounting. Okay? So once you understand that, I think the discussion would be a bit simple as usual. That is rupees 15 or rupees 18 ungranted, both these fair values, because if the share exercise price changes, the fair value of the option will also change. Okay, done. So then in 2015, you are talking about the calendar year as your accounting year. Okay, 1st January 15. Then on 2015 is now over. Then you find that the ROE for that year is 12%. And you are expecting that over the next 2 years, it would also be over 12% or at least over 10%. Your estimation is not changing. And then the question is, how do you do the accounting? So obviously, if that is the case, then the fair value I have to choose from 15 and 18. We'll talk about that. Let us go through the total question. In the next year, the ROE is 11%. That is the increases by 11%. Okay. So your target is still achievable. That's what you thought. But for some reason in the market or something happened, in 2017, the ROE just increases by 6%. So 12 plus 11, I believe 23, plus 6 is 29. So it's no more, the average increase of 10% is not there. So we missed the target, right? And it's a non-market target because ROE has got nothing to do with the market price of the share. Therefore, you put it as non-market target. Okay. And the director completes 3 years of service on 31st December 2017, I believe. Yeah, past January 15. So full year 15, 16, and full year 17. No, correct. I was just I got a little confused on the date of mine. Then let us work out the calculation. So since at, at the end of the first year, that is when you require your books of accounts to incorporate the option charge, isn't it? So you have taken a value of 18. Why is that? Let us check. You said if the average increase will be 10%, then exercise price will be 30, and based upon that, the fair value is 18. So out of 15 and 18, we have chosen 18 because we said still the 10% increase is likely to happen. Therefore, 2000 options into rupees 18. And since the vesting period is 3 years, one third you must charge to the P&L of that year. So 12,000 US dollar you have to charge to the P&L. That is one third of the total options value, ungranted. Second year also, when that 11%, I think 11%, yeah, 11% increase happened, but still you think the target of average 10% increase is achievable. Therefore, by the end of the second year, cumulative charge has to be 12,000 plus 12,000, 24,000. And again, you have to charge therefore the P&L 12,000. No revision is happening. But in the third year, it is, you have missed the target. You have missed the target. So your actual increase is less than 10% on an average. So then you have to revise the total options charge calculation based upon 15. But again to repeat, this 15 fair value is the value calculated on grant date, that is 1st January 2015. Therefore, in no case ESOP accounting is talking about exercise date accounting. The fair value based upon 40 rupees of exercise price was 15 rupees at the beginning of the scheme, granting of the scheme. That only you have brought in. So it is not that you are revising the fair value to exercise date. So then 2000 options into 15 total is 30,000 US dollar. But in the past 2 years, you have already charged 24,000. So only balance 6,000 has to be the charge in the third year. Then go ahead with the other issues, like obviously the directors will pay some cash upon exercise, then the share issue will happen. So as usual, cash will debit, then stock options you will debit, then equity share capital will credit, and if anything is there, you put in securities premium. Okay. So I think this clarification of 15 versus 18 is here. You please go through this. I have already explained that. Okay. Now we have not taken a case in this discussion or in this video, an example of an ESOP scheme where there is a market condition. Okay. Hey, it's a vast area actually. This body of knowledge has become very vast with IFRS, advent of IFRS. So then we'll talk about one scheme, that is share appreciation rights. In an ESOP scheme, ultimately you are giving a share to the employee or the director, right? But in a SAR scheme, share appreciation rights scheme, you are settling the scheme by paying cash to the employees. And accounting has one principle here, GAAP mandated principle. If a transaction has to be settled with cash, accounting does not treat that as a part of a component of equity. Accounting treats that as a component of liability. And one more issue you have to always bear in mind if you are trying to read financial statements. The moment one item is treated as a liability, please understand that accounting requires, I'll just type it out in caps so that it will attract your imagination. I'm just assuming it will be stored. If you are dealing with a liability has to be measured on every balance sheet date. I'll repeat it. If anything is treated as a liability, liability will be remeasured on every balance sheet date. But go back to the discussion, Isha. You are treating that stock options as a component of equity. You are not remeasuring that on every balance sheet date. How? How is that you are not remeasuring? Somebody can say that, Professor, we are uh, including the change in the expected vesting. So we are remeasuring. No, that's not the issue. You are in no way remeasuring the value of the stock option. You are sticking to the granted value. So in that context, remember, in case of equity, remeasurement in accounting is not allowed.